So the key thing was those acquisitions were principally debt financed. So in the take private, we had 180 million of debt on our balance sheet and just around 100 million of equity on that transaction. We delevered the balance sheet in relative terms because we bought well up until the ALM acquisition, the US acquisition. So our debt went from a multiple of our EBITDA from 8.1 times to 7.7, marginal, in July of 07. And then we levered up our balance sheet of the Incisive business and also the Target business to buy the ALM business. Now, this is not me being pushed by Apax or being pushed by the banks to take on this leverage. This leverage the debt was freely available on really good terms, and to show you how much a mug I was, I reinvested a very large check, several million quid, back into the business on the ALM transaction, because I looked at the returns you could get with very small earnings growth. And, you know, we had the classic highly levered model. We also, though, modeled the downside case on a downside scenario of the 1990 and 91 recession, and that downside case got us nowhere near to breaching covenants. So the debt grew to 445 million, which was quite substantial. Through the course of sort of latter part of 2007, the business was continuing to grow. We were seeing the value of the synergies that we were deriving from the transactions. And the shitstorm really started in 2008. We were very early into the downturn because two of the markets we served, believe it or not, were the mortgage market in the UK, and in the US, we targeted the real estate and legal marketplace. And we saw in 2008 an extraordinary phenomenon that our foreclosure notice advertising, it's a law in the US that if you foreclose on a property, you have to advertise it in a legal title. We own 6 daily newspapers in the US. Our foreclosure notice revenue went from 12 million to 40 million in 6 months. It just went up. But, of course, that was a sign, a positive sign, that the shit was about to hit the fan. We recognized actually early in 08 that life wasn't great. Now, our business was still marginally growing in the first half, but it started to really feel the squeeze towards the second half. And we took cost action actually in 08, early cost action, where there was 11 million of costs we took out of the UK business in 08, an annualized cost reduction of around 26 million in the UK business. And we also took about $24 million out of the US business. But when Lehman's went, it was absolutely overnight, it was a complete mess. Our business went from being marginally behind the prior year to literally overnight disappearing. People wouldn't go to conferences, so our delegate revenue fell off. And of course, 30% of our business was advertising-led. Every financial institution just shut up shop. It was the discretionary spend just literally went overnight. Recruitment revenues, which are luckily a small part of our business, fell by 70%. So we knew we were in trouble. We were heading fair, but we knew the UK business was going to breach covenants. The US business, just quick recap, the US business, we had RBS actually lend us the whole of the $430 million of debt to that business. We never syndicated the US debt. So the US debt sat under the US assets, but the common equity structure across the top of the business was Incisive Media, which also then held the UK assets where we had fully syndicated that debt in March 2007 and actually got reverse flex on that syndication where we had about a 5 million additional value to the business in that negotiation. So fully syndicated debt in the UK to 18 banks, not syndicated at all in the US. So RBS owned it all. We knew that we were in trouble. The debt that we had within the business was unsustainable, and we basically had to go, frankly, through a refinancing. Now, at all times, the business was profitable. The business was still generating significant cash, and it was profitable, but it was clearly below the covenants that were set and in ratio terms with the banks. So we knew that the debt was unsustainable. we had to go through a process of debt restructuring. And this is the really painful bit. So this is me. You can imagine even I'm Nick Farage. I'm coming out of the aeroplane, blood pouring over me. I'm coming out of the train. Thank you, Matthew. This is the train crash bit. I spent a year, a bloody year, from 7 o'clock in the morning until at least 10 o'clock every day in Allen & Overy's office, or Freshfield's office, or Apax's office, or RBS's office, negotiating the restructuring. Hardly a minute spent within the business doing what, frankly, I love doing, which is growing the business and talking to staff and talking to clients. So we went through a pretty rigorous process. Huge loads of advisors were appointed, advisors who were advising shareholders, the mezzanine lenders, the senior lenders, management, and the company. So we had an absolute swarm of advisors around us. And the negotiation was extraordinary. I mean, actually, I now know what Nick Clegg feels like, because I was the whore. I was the whore, frankly, tarting myself across the banks, across Apax, across the mezzanine lenders, but at each time trying to keep both the company's advisors happy, but also the advisors that were appointed by the banks happy. It was a really tough process, because my primary focus, clearly as a director of the business, was the good, keeping the business together and in shape and the best benefit of the business. But we realized quite early on, actually, that the negotiation really lay, like Nick probably realized early on, the negotiating fulcrum really lay with the senior lenders, because that's where the value broke. We had two things. Our earnings came back in 2008 and into 2009, as well as the market comparables coming back to be the lowest rating in the B2B media sector that we had seen for 20 years. So you had a double whammy in terms of value. So our rating went from, we sold the business at 14.6 times. The ratings, the average ratings of publicly traded B2B businesses went to 5.5. So actually, if you take the business off the market with 9 times debt, and your value is in at 5.5, and your profits come back, you're in trouble. So we recognized that actually the banks had various options: sell the business, bring in new management, bring in new private equity, do a lender-led solution, reset the covenants, or restructure. I mean, they had to restructure our business because it was so harsh. So we set about that negotiation. We also, though, had to then renegotiate with Apax, who were trying to get back into the structure, and the Mez, who put a proposal together. We also had, at the time, an offer that came in from a SPAC, a special purpose acquisition company in the markets, that actually valued the business at 14 times earnings on a cash basis. And luckily, that offer came in just a little bit too late. The banks just didn't see it as serious. So, huge amount of negotiation, huge amount of angst. Our big problem, believe it or not, was the fact that our business had cash. The business wasn't going bust. It didn't have a cash issue. So because of that, the banks just spread this negotiation out for this year. So the lesson that we learned as management is that we actually had to try and put a full stop to this negotiation. And actually, the only way that we could put a full stop to the negotiation was to say, enough's enough, we're off. So we had to play the ultimate card, or the ultimate hand, in that negotiation to get a deal done. Luckily, the banks wanted to support the management team. And we got a deal done, and it was signed just before Christmas. And in that deal, we wrote off, of the 240 million of debt in the UK business, we wrote off 140 million of debt in exchange for the banks taking basically 75% of the equity in the business, and putting in a really progressive and aggressive ratchet in place for the management on performance. So the company's in a better place because it's got a lot less debt. The debt clearly is at probably the maximum the company can service today, but we are a cyclical business, a deep cyclical business. We now believe very firmly over the course of the next 3 years, as we get recovery and management focuses entirely on the internal drivers of the business, that actually there's a fantastic incentive for us and for our staff to get the bank's money back.